Thank you very much. Good afternoon, everybody, and welcome to this workshop at Point Zero on scaling fund management for modern investment. My name's Angie Walker. I work for Chainlink Labs, and I'm the moderator for this panel today, and I'm delighted to have you here. It's a very topical subject, as we all know, and I'll start by asking our esteemed panel to introduce themselves.
So I'm Isabelle Delorme, Product Strategy and Innovation at Euroclear. Very happy to be here, obviously, and thanks for the invite, Angie.
So I'm one of the founders and the CEO of Marketnode. We're a licensed market infrastructure firm that is building next generation funds market infrastructure out of Singapore. When we think about bringing more funds on chain, really it's not just about tokenization. It's a combination of data, transaction, transfer agency, which I'm sure we'll speak about, and also operations. And we try to bring that together under a single operating entity. Thank you.
Victor Zhang, I head the digital assets department, which is a one-man department at Hamilton Lane. And Hamilton Lane is a NASDAQ-listed private equity player with 1 trillion approximately of assets under management and under advice. We we use blockchain as a solution to further democratize our funds to for the retail audience in the world.
Thanks, Victor. Okay, so I'm going to do a quick scene setter just to get us kicked off. So. The next 20 years is predicted to see the biggest transfer of wealth. We're expecting, as a part of that, to see very big changes within asset management and wealth management. We are also seeing, in terms of the retail community, we're seeing very big changes in the way that retail investors operate, the way they invest in assets, the type of assets they invest in, and the way that they interact with the different asset types and the way they manage their own portfolio. So what we're going to look at is, first of all, we're going to look at the view from a retail investor perspective, what are we seeing? And then we'll go on to see what it means to the asset manager. And also then we'll look a little bit at the infrastructural impacts of using blockchain, DLT and tokenization. So we'll look at it from 3 angles, with fund managers and the retail investor and the impact from the retail investor's perspective. And I'll start first by asking Isabelle what your view is on how that's set to change over the next 20 years.
Thank you. Very shortly, because I'm in the wholesale industry, so I think my co-panelists will be more talkative on the retail investment. But what I can say to your question is to say, every month when there is a survey about the retail behaviors and investment patterns, I mean, it's so impressive to see how many retail investors hold cryptocurrencies. I think 2 weeks ago we had the French report. It was 12% of the retail investors having cryptos. I mean, nothing compared to the US or Asia, I'm sure. So not having the last figures, it's always impressive. The thing we can say from the Euroclear angle is that this kind of purchase patterns and the features that come with that, like 24/7 operations, instant purchase, these are things that will necessarily influence the institutional investment and the way the market is organized. These kind of benefits, 24/7 and instant purchase, will become the norm, will become the new normal. So a long series of players have to adapt to that and be ready for this new challenge, again, in a few years' time from now.
Rehan, from your perspective, what are you seeing in terms of the difference, or what's coming towards you, basically?
Sure. So you mentioned earlier about generational gaps and wealth transfer. We're in Switzerland. I'll share some numbers from Asia. So let's talk about 2 key markets. When you look at Singapore as a market, total funds booked in Singapore, about 4 trillion. You look at Hong Kong, total outstanding funds are roughly 4 trillion as well. And so from an AUM standpoint, that's quite chunky. Switzerland, I understand, Victor was telling me it's about 3.8 trillion, right? Pretty chunky. And when you look at the generational gap, demographically it's quite interesting, because I'm based in Singapore, which is part of South Asia or ASEAN, where by 2030, the expectation is there'll be 8 million plus millionaires in that region, right? So people getting richer is a term we like to use called Henry, Henry, high earner, not rich enough yet. There's a demographic change. We have a lot of younger people who are coming in. So wealth transfer will become a much more intense concept in that part of the world, given age and given all of that, right? The angle we are looking at is, traditionally when you look at operations like transfer agency, how can that be part of the value chain, as opposed to waiting for funds to settle, in some cases, frankly, in Asia at T+10. How do you bring that down to T+2, T+1? Or can there be different formats? So Isabelle was talking about my nephew, as an example, doesn't know how to trade using a traditional broker app, right? How does he get access to his funds in a wallet, right? So these are some of the interesting areas hopefully I'll be able to share some light on. Our tailwind is a large young population that is interested in commingling of digital assets and traditional assets in digital format.
Victor.
A bit more structural. First, thanks to Chainlink for having me here. Could be slightly a bit more different when it comes to where I start. So I would like to ask the audience if you all know, let's say, is private equity funds, are they eligible or accessible to the non-professional retail? Can anybody tell me in the audience? If you're not professional or not accredited, can you invest in private equity? Typically not. Why not?
Because you're not sophisticated.
Yeah, and you're not rich enough. That's like he said, Henry's, right? Henry's is a good name. Just think about Henry because that's the audience. High earners, not rich yet, right? This is very important because private equity as an asset class has outperformed the publics. You see Mr. Larry Fink talking about democratization. You see Robinhood Vlad talking about democratization. Everybody's talking about democratization of private markets. Why? Because it's not accessible for retail, from a retail perspective. Why? It's a regulatory matter. Now, it's been 40, 45 years of history in where a retail investor has not been able to access by right to this asset class. Why this is important? Traditionally, the regulators prohibited or limited the access of retail investors to private equity because their statutory objectives dictate that they need to do retail protection and maintain financial stability. Now, what does that mean when you have 100 billion worth of Bitcoin ETFs available for retail? And back to the gentleman that just said about the accreditation, do you know what the volatility of Bitcoin is?
I don't know.
Anybody in the room?
Very high.
Very high. How high? Okay, 80%. Anybody can tell me the volatility of the public markets? Give or take? Anybody? 10 to 14. Yeah. If you put private markets in a fund and you put it under metrics, it's 5.7%. So today, how do you justify allowing the Mrs. Smith to buy a Bitcoin with an 80%? I'm not saying you shouldn't do. You should, right? But you shouldn't do a YOLO, when you're not rich. Same with crowdfunding. You shouldn't do a FOMO all-in with the little that you have. Private equity traditionally, let's put blockchain aside, has been you need to have 10 million minimum commitment, 10-year lockup capital calls. No one understands. And with blockchain, you can help that. But fundamentally, this generation, MZ or XYZ, whatever you want to call it, this wealth transfer will greatly benefit private markets and vice versa. But today, they don't have access. And if you're not rich and you don't have access to private equity, what are your three options that you have? Number one would be the millions of cryptocurrency. Good luck. You do an all-in there and let's see what happens. Number two, I call it private equity for the poor. This is the SPACs, right? SPACs is in essence retail eligible, but no track record and even more expensive. And number three is meme coins. Meme stocks, sorry. This is like the likes of GameStop, et cetera, where you cannot justify GameStop, for example. They are a offline video game selling business, so you cannot even digitize that business, and they're at some point valued even more expensive than a Twitter. So they're destined to fall. What I'm saying, Mrs. Smith shouldn't be exposed to those three, but that's the only choice that they will have at this point in time. And together with regulation and capital markets engineering and blockchain, I think we will be able to address, and we at Hamilton Lane, we've already done it for the first time in US capital markets history. We've fractionalized private equity. Instead of the 10 million, we fractionalized it at $500. In Switzerland, we did it for the accredited. We couldn't pass that hurdle with a bank called Signum. This is public information. We fractionalized at 1,000 Swiss francs with no capital calls on a fully paid-in mechanism. And the journey has just started.
Hold that thought. So we know that private equity, and we know that the retail community are diversifying into other asset classes. We know there's incredible interest in both on the retail side and on the institutional side in investing in money market funds. We know we're seeing, along with infrastructure and private markets, we're seeing a lot of tokenization around money market funds. So my question is, Why is it there are certain asset classes that are becoming increasingly popular, like money market funds, both on the retail and on the institutional side? And how will we deliver that in a digital asset world? How will we service that need in a digital asset world? And can I ask Rehan that question first?
Sure. Actually, it may have better context if Victor answers it, and then I can go through.
Okay, no worries.
So the adoption of private markets as an asset class, how this will be adopted?
In terms of money market funds and how the critical way in which digital assets are being adopted and the way they're being deployed and used.
Yeah.
So if we think about the tokenization and then the secondary use of things like money markets in the form of collateral, how do you see that unfolding?
You have to remember that private markets a few years ago used to be called alternative because they were alternative to listed equities. It was unlisted, so they call it alternative. But the pie size grew so big, it became private versus public. So in that context, the industry is moving first with money markets. And money markets now, there's a convergence play with stable coins and security tokens. But what we see is adoption to money markets will come first. This will be an instrument. Now with Treasury, so it's education, right? The foundations and the retail investors are learning that, doing an all-in. So everybody says don't invest, don't put all of your eggs in one basket, right? So holding single shares is dangerous. So you see, it will go from money markets, and then they are finding out that there's something called hedge funds, real estate. And that's all on the private market. So private equity is betting against the market. It's like you cannot contract your revenues in a supermarket, whatever sells. Real estate is a landlord-tenant contract. So if the tenant's credit rating is good, then you pay. So the returns are higher. So its infrastructure is even higher because it's the government. So people are learning, hey, with private credit, for example, you're getting higher returns. So money markets gives you, let's say, 3 or 4%. Let's go through something higher with less liquidity. And as they learn, it will the adoption of this will become higher. But with blockchain tokenization, what happens is I see a lot of investors that are using my funds, clipping in the 10 to 11% net. They're collateralizing my fund's position in a token, putting it on a vault, using it on a permission DeFi ecosystem, and getting another 10%. How do you do that? A bank wouldn't allow a bank. You can get a 40% loan, but you cannot get an extra 10%. So with the new investors becoming sophisticated with a cheaper entry point, better structures, right? Self-custodized wallet, right? For example, more liquidity and atomic settlement. That's the fastest. So it's always cheaper to the client, better in terms of liquidity and faster atomic settlement. Once they get used to those three, I think there will be an exponential adoption. It's a matter of the regulators allowing crypto and real world assets to converge and make it interoperable. And here's where the clearinghouses and the custody and the exchange have to be able to cater for the demand of the client.
We'll come back to the operational benefits in a moment, but Rehan?
Yes, thanks for that, Victor. Yes, okay. So let me explain the plumbing behind it, right, at a very high level. So I don't expect everyone in the room to know what a transfer agent does, but at a very high level, typically a fund manager will appoint an agent that does a lot of the background work, fund orders, subscriptions, notes, et cetera, et cetera. And let me switch gears by using a different analogy for transfer agents. I moved to Asia in 2010, right after the financial crisis, and Singapore has very fast broadband coverage, right? Just because it's a very advanced nation in that way. But actually, I found after a year of traveling that the country with the fastest broadband speeds was actually Sri Lanka, right? The reason behind that was they just got out of a war. There was no 0G, 1G, 2G. They just moved straight into 3G, right? At cost-efficient economics. With transfer agents, actually, the journey is a little bit different, right? When you move from 0G to 1G to 2G to 3G, it's not just it's not just a broadband operator that has to change. You basically have to change your phone, right? So when you think about transfer agents who have been running, frankly, the processes work. Exceptions do happen, challenges do happen. But by and large, that thing has been running for multi-trillion industries to date, right? So we think about, okay, how does the transfer agency world need to evolve to support the 2G, 3G, 4G, 5G of fund distribution, right? And at Chainlink, we're very big fans. We completely buy into the interoperability standards. We buy into the need for that. But when someone says interoperability to us, we are thinking, how do we adapt to a brand to, frankly, a transfer agency system built in 1992. That's the first hurdle you have to cross, right? Because fund managers in Asia are very cost sensitive, as anyone who's been in Asia knows, right? For them to go and appoint a new transfer agent, a new custodian, a new placement agent, it's a lot of outlay, right? Especially given the current macro environment. So there's a lot of plumbing to be done. These are multi-trillion industries where you have wealth transfer coming up. But we're trying to figure out what is a very cost-efficient infrastructure for us to upgrade the transfer agency workflows, right?
Yeah.
So a lot of work ahead to do.
And I think it's important, the point you made about how the digital world interfaces into the existing world, that can't be, it's not a binary switch, right? We have to live with, those technologies have to coexist for a very long period of time. Isabel, from your point of view, where do you see it going?
Maybe a few words on the fact that, for the sake of transparency, Euroclear invested in Marketnode as a first investment in Asia, a strategic investment of ours, because we believe that we can together reshape the funds management process for the exact reason you mentioned. I think to your point, both of you, I think funds, mutual funds, private funds, ETF is probably the family of asset classes where we can make a difference. To your first question, I think the traction on bonds is not obvious. We've seen a few early adopters in the industry trying to see what's in it for us in the bonds market, but obviously starting with the right asset class is probably an important decision to make as an industry. And on the funds business, this is where the automatization can bring the most value, I would say. But probably in the rest of the panel, we will discuss the degree to which we can automate the private funds market, which is still a question mark and a lot of work. But no doubt that money market funds, mutual funds, private funds is the asset class where we can really bring benefits to the different players.
So let's switch to the operational side, look at it from the operational side. If we look at certainly one of the experiments or one of the projects we were involved in last year was the Guardian project. I mean, it's an ongoing program of work, and we actually did some collaboration with UBS SBI and Swift to show how we could, to your point, Rehan, how we can then automate through the use of the ledger and smart contracts, the subscription, the redemption, life cycle, driving that through smart contracts and then going on with the integration into Swift for the payment leg in the absence of having atomic settlement on chain. So there is the opportunity to make significant improvements, not just in terms of how we service digital assets on chain natively, but also in how we service existing assets with and bringing down the cost of the existing fund servicing, basically. So the question is, how can we leverage the technology? So this is more of a technology, from a technology angle. How can we leverage the technology to improve the way we operate, both with natively tokenized assets, but also in terms of improving the way we service and manage existing assets as well? So it's sort of coming at it from both directions, basically. Do you want to go first?
Yeah, sure. I'll share some scar tissue or professional expertise in this space, right? So there's a lot of literature out there on transfer agency savings by going to a new system, blockchain-based or not. Depending on whose articles you read, including ours, the savings are somewhere between 50 basis points or 50% to 65%, somewhere in that region, right? We're a commercial entity. I think TA savings excite people, but the willingness to pay for that change is a completely different story, right? Where people are a lot more generous is if it can help expand distribution, right? So our focus as an infra firm has been, now that we have received a license, it's really been, how do we take the infra to actually enable quicker distribution? So let's talk about a simple thing like account opening, right? So today, for example, we are in the process of doing an account opening for a fund manager as a client. And I think it's been 3 days for us. We're still waiting, right? How do we work with, for example, Euroclear, one of your subsidiaries is Global Watch, that has an existing universe of 1,600 distributors and fund managers on it. Is there a way for us to work easier with a Global Watch to automate KYC, KYB, and onboarding? Potentially. So my view of this is that there's a lot of work done on efficiency in the back end. A lot of our energy as an infra provider now has to be about how do we either manufacture assets quicker, or how do we do things like account opening, KYC, KYB, to enable quicker distribution? Because we will reach a fatigue point on efficiency quite soon.
Right? Yeah, And I think the account opening is a really interesting area. The onboarding, I think, is one of the areas where we could really see significant, and passporting of identity is another area where I think we can see really significant improvement through the sharing of data on chain and cross chain, basically.
Can I just add something on passporting, because it's very topical.
I know it's a very topical subject. Yeah.
So just in passporting, ASEAN, which is South Asia League of Nations, we tried this concept called fund passporting 14 years ago.
Right.
I think there's one fund that is passportable.
Okay.
I'm just trying to show that whereas the technology may be up to it, there's another leg which is legal, reg, cross-border, frankly, even geopolitics now, that can actually constrict that. Right, so it's not everything is a technology issue.
You're right. It's probably not necessarily a technology issue. So,
yeah, I mean, maybe we can spend a few minutes on what we did together on the corporate actions. Also, because I mentioned that there is a limited traction on the bond side. So, what can we do with those technologies on the traditional assets? I think important to mention the long-lasting problem of the industry. The fact that we don't have real-time standardized data. The fact that we don't have a golden record for securities, forcing all of us to reconcile, clean the data, etc. So we have a burden of work on making sure that we have the right data at the right moment. Looking at new issues, prospectuses, general meetings, notifications, dividend payments, all of that requires intense cleaning data work. And what we have been experimenting with Chainlink, Swift, and a series of large banks and issuer is the fact that with a large language model and blockchain, you can basically structure the data that is totally unstructured, like human readable data today in PDF and so on. You can extract them and manage to rebuild, reshape a golden record of the necessary data to make sure we gain efficiency. And I think a few times, typically in the new issues process, we have been able to save more than 80% of the time usually required to manage such an operation. So I think definitely we can automatize. There is a lot of actions, corporate actions, and typical operations we can automatize. My input would be to say, is it enough? Is it sufficient as an industry to state and declare that we can automatize most of the tasks we have? Because if we can technically automatize, legally speaking, when it comes to liability, when it comes to compliance rules, we can automatize a lot, but you need somebody to put in the list who is allowed, not allowed, who can do that or not, what are the compliance rules about. So updating all the rules and recipes and authorizations is something that require, at the end, liable players. So I would say this is that there is still a lot of work to go farther in the automatization, but as well to define as an industry, again, as capital markets players, who does what in terms of liability and how do we transfer that in the new world?
I think the corporate actions project is particularly interesting because I had the good fortune a few years ago to do something similar post-trade, and we actually did it on FX, to be fair, but we took a post-trade transaction from match to settle, and we showed how you could collapse the whole transaction onto the ledger. So instead of having this process where you had 9 stages of reconciliation, you could actually collapse the entire life cycle onto the ledger, and it could be just one record of what I see is what you see. On corporate actions, I was reading the report that was issued, commissioned by DTCC, and the Value Exchange wrote it. I think Broadridge might have been involved as well. And last year they issued a report that said that a typical basic corporate action takes about 100 people. Like 100 people touch a basic corporate action in order to process it. And that's why the cost of fund servicing and asset servicing is so expensive, because we still have around 60% of the processes in a manual form. So it is, there is a great opportunity. So Victor, from your point of view, I know you're very excited about the asset class coverage and the end consumer, but from an operational perspective, what do you see?
Just thinking on how to excite the audience, because what we are talking about is something that is not seen and appreciated every day.
It's not, right?
So it's like if you look at an Apple Pay, there are 7 different steps that goes into, but it happens in a second, and we don't bother to know what the 7 steps are, right? We just pay for it. I think this is the same case. And I'm sure half of the audience don't even care what happens behind because you're paying for it. But I'm saying this because there's so much, I call it back is the new front, because without these steps, you can't have the end result. And once you miss on a step out of this, 10 processes, something will go wrong. And downside of being a market infrastructure is that once you fail once, you're done. Like the perfect case is base case. Now for us, it's a little bit of a different story. We can fail from time to time because unlike the bonds or the ETFs or the equities, we are so Neanderthal. So again, let me ask again the audience, how many have you subscribed to a private equity fund? Anybody? How long did it take you?
5th year.
Okay. Oh, 5th year. How long did it take you to subscribe the paperwork? The subscription doc? Couple of weeks. See, for us, we don't even need blockchain, right? If it's just digitized, it's good enough, but why go with Napster when we can go with Spotify? With I ask all of our fintech partners to really do a traditional subscription form. You know what happens? They vomit. Because these guys, they all have ADHD problems. They cannot stand being on the same UI for more than 2 minutes. They can't. So what they do is they're shocked because trading is relatively well digitized. Private equity, you need to do 3 weeks of wet ink signatures. Today even DocuSign is outdated. So what we do is we pre-populate KYC AML. And what people don't know is, let's say you invest on Hamilton Lane Fund one time, like Netflix. You go once. Do you need to download it? Do you need to re-register for membership for the second time, third time? No, you register once and you're done. In private equity, people don't know, but every time you want to invest into a fund, you need to go through the KYC AML process again, and do that same 3-week process again. Why wasn't this a problem? Because they're all rich institutions and they have a 70% of the back office to just focus on, they have a job just by filling docs and getting the dividends and testifying for the KYC AML documentation. Now, where I see all of these processes and the market infrastructure helping us is, for example, a wallet address, let's say in the future, if it's self-custodized or not. This would really help us to have, to cut the redundancy. And for me, convenience beats everything else. Like, let's say why there's no 100 billion worth of Bitcoin self-custodized, and there's $1 billion of Bitcoin ETFs is because ETFs are very convenient. You don't have to change anything. We're all lazy people, right? That's why we love digitization so much, because one person can do everything with AI. It's even worse. But convenience is king. But I think with all of these trends and blockchain and digitization, I think private equity is poised to really benefit because it just makes it cheaper, better, faster. Just like this Apple Pay, I don't carry any more wallets. I used to carry just a symbol of bragging, but I don't need that. I don't lose it. It's with me. So I think the same thing will happen. And with the young people, anything that is convenient that will skyrocket.
Isabel.
Yeah, I would like to reassure Victor and all of you about, not easy to be in infrastructure because we cannot fail. But actually, our fund settle platform, we have 99.98% business continuity. So we know how. And we are ultimately, liable for the settlement. Settlement finality stays with the market infrastructure. So far, so good.
I know we're out of time because I've been monitoring it. Just very quickly, single answer. Over the next 5 years, your view, what percentage of assets do we think will become tokenized over the next 5 years, roughly speaking, in terms of the world of assets today?
Okay, I'll just focus on funds. Pareto principle, I'm an economist, so I think 20% of outstanding funds in some markets will be in tokenized form. 80-20.
I have no clue. Just maybe to mention the usual phases. This exploration phase, which I think we are a bit at the end of the exploration phase and the early adopters. We can mention a lot of people, I don't want to cite all of them, but this phase has lasted probably like 8 years. So if we say that we have this exploration phase and then the adoption and then ultimately maturity and scale up, if the first phase has been 8 years and it maybe last 1 or 2 more years, it's going to be long. I cannot predict how much of the stock will get natively tokenized in the coming 5 years. I don't know.
I'd say I've always been in the business of over-promising and under-delivering, and always thinking that the market would be 100% tokenized by now, even my picture. But it's to be fair, it's been very frustrating. Hence, in a short answer, I would give it a 15 to 20, given that there are still a lot of things that needs to be harmonized and agreed, regulator, the players, and the market infrastructures.
Yeah, that's interesting. So if there's 84 trillion, or certainly the reports that are being published are suggesting there's certainly in excess of 80 trillion of assets going to be transferred to Gen Y, Gen Z over the next coming 20 years, and we think 20% of assets are going to tokenize in the next 5 years, you can imagine how fast that transformation is going to take place, because the way they invest is fundamentally very different to the way that we invested when we started that journey 20, 30 years ago. So we've got to wrap up. I'm sorry it was very fast, and I'm furious, but I'm delighted, and I must say a great thank you to Isabel and Victor and Rehan. It's an amazing session and very lively, and I really appreciate it, and thank you very much for your time.